Welcome to the Deep Dive. Today, we're taking a scalper to the Q3 fiscal year 2026 earnings results, released November 19, 2025, for, well, the company that's pretty much defining the global AI arms race.
And our mission today is pretty straightforward. We need to filter through these massive financial statements and really zero in on the aggressive forward guidance.
Right, because it's not just about the numbers they just posted. It's about what they say is coming next.
Exactly. We're going to understand how these projections, especially for Q4, are fundamentally tied to their long-term vision for AI infrastructure.
Okay, let's unpack this scorecard immediately, because the high-level outperformance was, it was undeniable.
It really was.
Q3 revenue didn't just meet expectations. It set a new record at $57 billion. That's a 62% increase year over year.
And it comfortably surpassed that $54.89 billion estimate. It was a clean beat across the board.
Which is exactly why the market reacted so strongly, right? The stock was up nearly 3% after hours.
Yeah, and on the profitability side, diluted EPS came in at $1.30, both GAAP and non-GAAP, beating the $1.25 forecast. It just shows remarkable scale, but also, remarkable efficiency.
That efficiency, that's a perfect lead-in to the forward guidance, which is arguably the most important metric here. What are we talking about for Q4? Because that growth rate already seems, well, unsustainable.
Well, they just raised the bar even higher. NVIDIA projected Q4 revenue to hit $65 billion, plus or minus 2%.
$65 billion. So that midpoint suggests a stunning 14% sequential growth.
The speed of acceleration is still increasing, even off this massive base. It's incredible.
Okay, $65 billion for one quarter is just phenomenal. But whenever I see a growth story like this, I want to talk margins. Q3 non-GAAP gross margin was 73.6%. How do they maintain that, let alone project an increase?
This is where we see what they call their architectural mastery. The Q4 non-GAAP gross margin is expected to hit 75%, plus or minus 50 basis points.
75%. Why is that mid-70s margin so crucial?
Because it tells you the company isn't just selling commodity chips, Yeah. They're selling proprietary integrated systems.
So it's about the whole package.
Exactly. They credit this margin improvement to the transition from the older Hopper HGX systems to the much more complex, full-scale Blackwell data center solutions. These new systems, the GB200, and especially the ramp of the GB300, they just offer higher revenue per system and a better cost structure.
So they're selling solutions, not components. That distinction is vital.
It's everything.
The Blackwell ramp is clearly the central story, so we have to dive into the engine driving the data center segment.
Right, and this segment isn't just large anymore, it's an economy unto itself. Data center revenue hit an all-time record of $51.2 billion in Q3.
$51.2 billion, that's up 66% year over year. And you just think about that scale.
A 66% increase on a revenue stream that was already over $30 billion a year ago, it's mind-boggling.
And breaking that number down gives us the real insight, right? Compute revenue was $43 billion, which is impressive, but networking was $8.2 billion, up a staggering 162%.
That networking figure is probably the most profound insight in this entire report. It signals a structural change in how AI is being deployed.
How so?
Their networking business, so that's NVLink, InfiniBand, and Spectrum X Ethernet, is now officially the largest networking business in the world, full stop.
Okay, for you, our listener, who might not be building a supercomputer at home, can you quickly explain why that networking growth is so important?
Absolutely. Think of the GPUs, the compute, as these incredibly powerful engines. But if you have a massive farm of them, thousands of them, you need a way for them to talk to each other instantly.
That's the networking fabric.
Exactly. InfiniBand is their proprietary super low latency highway. It connects all those GPUs so tightly they act like one massive brain. The growth there means customers aren't just buying a few servers. They are building enormous dedicated AI factories.
And that demand signal is deafening. The CEO said, quote, "Blackwell sales are off the charts and cloud GPUs are sold out."
And within that demand, the product mix is shifting incredibly fast. The GB300 ramp is now the primary driver for compute growth.
So they managed a seamless crossover from the initial GB200 systems to the enhanced GB300 platform just in Q3.
Yep, and the GB300 contributed roughly 2/3 of the total Blackwell revenue in the quarter. The speed of that transition is key.
Which brings us to the number that truly made my jaw drop. The company has visibility into $500 billion of Blackwell and Rubin revenue from now through the end of calendar 2026.
500 billion. That figure isn't just a number. It's a statement about market confidence and, frankly, strategic lock-in.
So it's not just a projection, they have contracts.
They're securing large multi-year contracts with massive prepayments or ironclad commitments from hyperscalers and entire nations. It's $500 billion of certainty built into their roadmap.
And that de-risks their supply chain expansion. Speaking of which, how are they handling that massive commitment? We always hear about bottlenecks.
They're preparing aggressively. Inventory grew to almost $20 billion. That's a 32% jump in one quarter. And their supply commitments rose to over $50 billion.
So they're placing huge bets now to guarantee they can meet that demand curve later.
You have to. You can't build this kind of hardware on short notice.
Okay, we absolutely must address the China market, given all the geopolitical friction. How did the restrictions impact Q3? And more importantly, that Q4 guidance?
The sources were very, very clear on this. The modified chips for China, the H20 accelerator, sold in, quote, insignificant quantities.
How significant?
About $50 million. Sizable purchase orders they were expecting just never materialized.
50 million. That's a staggering reduction. So when we look at that incredibly bullish $65 billion Q4 outlook, are they factoring in a rebound in China?
And this is the massive caveat that you, the listener, need to understand. The entire $65 billion Q4 revenue outlook is based on the explicit assumption of zero data center compute revenue from China.
Wait, say that again? They're forecasting a 14% sequential acceleration to $65 billion, while assuming a multi-billion-dollar market goes to zero.
Precisely. It puts the staggering, unprecedented demand from the rest of the world, the US, Europe, sovereign AI initiatives, into sharp focus. The growth is purely ex-China.
That makes the forecast even more remarkable. It's a powerful transition point. Let's move from the results to the strategic why. This is Jensen Huang's thesis on why people are funding $500 billion of infrastructure. He calls it the 3 simultaneous platform shifts.
Yeah, and this framework is critical. He argues we're living through 3 profound transitions happening all at once.
Okay, let's break down the first one. He calls it the necessary shift.
Shift number 1 is the move from CPU general-purpose computing to GPU accelerated computing. It's necessary because Moore's law, the engine that made computing cheaper and faster every year, has fundamentally slowed down.
So to keep getting performance gains, we have no choice.
We must switch to accelerated computing, which is what GPUs do best, handling those highly parallel tasks like AI.
Okay, that's the efficiency shift. What about the second one, the transformative one?
Shift number 2 is the move from classical machine learning to generative AI. This is changing the foundation of every major internet company. Old recommendation engines are being ripped out and replaced by massive generative foundation models.
Do we have a tangible example of how a company justifies spending billions on that switch?
We do, and it's a brilliant one. Meta replaced their older ad recommendation systems with their new GEM foundation model.
And the result?
That change alone drove a 5% increase in ad conversions on Instagram. When you're Meta, a 5% conversion lift is billions of dollars in new revenue. That ROI is what justifies building gigawatt-scale AI infrastructure.
That makes the expense feel less like a bet and more like a necessary investment. Okay, what about the third shift, the revolutionary one?
That is agentic and physical AI. This is the net new stuff. It's not about replacing an old system. It's about creating entirely new applications that can reason, plan, and use tools.
So things like Tesla's full self-driving.
Exactly. Or factory digital twins where robots learn in a simulation. These are entirely new markets being created.
And this sounds like the segment that's going to drive that massive $3 to $4 trillion market estimate they've been floating.
That's the idea. The company estimates the total annual AI infrastructure build by the end of the decade could be in that range. You have replacement demand from Shift 2 and entirely new demand from Shift 3 happening at the same time.
And this strategy is driving the new alliances they announced. Anthropic and OpenAI really stood out.
These are monumental commitments. First, Anthropic is now committed to the platform, committing up to 1 gigawatt of compute capacity using Grace Blackwell and the next-gen Vera Rubin systems.
I have to stop you there. We used to measure compute in teraflops. Now it's gigawatts. What does 1 gigawatt of compute even mean?
It's a measure of power, right? It means the physical footprint, the cooling, the energy required to run potentially hundreds of thousands of AI accelerators nonstop. A small nuclear power plant's worth of power.
So Anthropic is betting their entire future on NVIDIA's roadmap. What about OpenAI?
A strategic partnership to build and deploy at least 10 gigawatts of AI data centers. And interestingly, NVIDIA is supporting OpenAI's self-build infrastructure, not just serving them through clouds like Microsoft Azure.
Which keeps OpenAI committed to their core technology, even if they build their own data centers.
That's the strategy, and it all ties back to the total cost of ownership, or TCO. That's what keeps customers locked in.
The ultimate advantage. Explain that.
The core platform, CUDA, allows the 6-year-old A100 GPUs to still run at full utilization today. Why? Because the software ecosystem is constantly being optimized. A competitor's chip might look cheaper up front.
But if the software isn't there, the hardware is a paperweight in 2 years.
Exactly. The TCO advantage isn't just hardware, it's that the code written for an A100 still works perfectly on Blackwell and Rubin systems. That makes a multi-billion-dollar investment feel a lot safer.
Before we wrap the financials, let's quickly hit the other revenue streams. They show the adoption is broad-based.
Absolutely. The rest of the business is exceptionally healthy.
Wow.
Gaming revenue was $4.3 billion, up 30% year over year, and channel inventories are now normalized, which is great news.
Professional visualization also saw a strong boost.
It did. $760 million, up 56%. That was boosted by their new DGX Spark, which is like a small supercomputer for research labs.
And automotive.
$592 million, up 32%. The big news there was an expanded partnership with Uber to scale a Level 4 autonomous fleet. They're targeting 100,000 vehicles by 2027.
So moving from assisting drivers to powering completely autonomous commercial fleets.
A huge step up.
Okay, final financial health check. Despite investing $50 billion in supply chain commitments, are they resilient?
Immensely. Free cash flow was a robust $22.1 billion. They're funding their own aggressive growth and returning massive amounts of capital to shareholders.
Massive.
$12.7 billion returned in Q3 alone through buybacks and dividends. And they still have $62 billion left on their repurchase authorization. It just screams financial confidence.
Finally, looking beyond Blackwell, we have to mention the next architecture, Rubin.
The Rubin platform is on track for the second half of 2026. It maintains that annual architectural cadence. The sources confirm Rubin is expected to deliver another X-factor improvement in performance.
So that rapid annual leap is the tool they use to keep every developer locked in.
You have to win their support with a superior platform year after year after year.
Okay, so to summarize the narrative for you, massive growth now, driven by unprecedented ex-China demand for accelerated computing, and even more aggressive growth is expected immediately ahead, backed by $500 billion of forward visibility.
That's the near-term takeaway. But here's the provocative long-term thought that I think ties this all together. The data proves customers are funding these massive AI builds, migrating old systems, and simultaneously funding net new agentic AI apps. So given that the architectures, like Rubin after Blackwell, promise an annual X-factor performance leap and a huge TCO reduction, we have to ask.
Go on.
Will the accelerating pace of technological improvement and TCO reduction accelerate demand and adoption even faster than the unprecedented supply chain investments being made?
That question really highlights the core dynamic here. If the cost of adoption drops while the power increases exponentially, the ceiling for demand doesn't just stay high, it vanishes entirely. We'll leave you there to mull over those 3 revolutionary platform shifts.